Hey everyone, I know we've got a few more minutes here before the actual lecture begins. Um, Hopefully, I can see we've got about 9, I'll jump to 12 now online already. I'm trying to kind of keep my eye on the chat feature again as best I can. Hey Ryan, good to see you again. Hey Samantha. Again, I'm hoping the lag's not too bad. Samantha, were you able to get the lag figured out? Hey Arjun. Hey Alex. Don't know. All right, fair enough. You're able to post pretty quickly, so hopefully the lag's not too bad. Hey Natalia, good morning. Hey Matthew. Well, hopefully the Samantha. Hopefully it's okay. Hey Darshan. Give it another minute too here. Well, I hope everybody's enjoying the sunshine. Was it at least not the cold? Last night it was pretty cold, but I don't know. Hopefully it gets warmer. I'm gonna give another minute or two. Oh, you know what? I will talk quickly for those that didn't get a chance to see. Um, I posted it, I think, yesterday, talking about Test 5. Um, what I'm doing with Test 5 is there's going to be like a spreadsheet tool for the statement of cash flows. And so definitely practice that because what's going to end up happening is when you do the test question, you're going to click on a link and it takes you to a spreadsheet that you can still use within Lockdown Browser, but it's not quite like Excel, so it does take a little bit of time to get used to. Hey Joanna, it takes a little bit of time to get used to it, like adding columns and rows and things like that. It's just a little different. But I have a practice test that uses the Lockdown Browser and everything else, and so you should be able to use that to get used to it. If anybody's had a chance to check it out, feel free to put it in the chat whether it went well or didn't go well, if there's anything I can do to format it differently. But what I tried to do is to take all the information in the problem, put it in that spreadsheet, so you don't have to bounce back and forth between the information and your solution. Is the practice actually the practice test is with it's under quizzes. And so there should be 2 practice quizzes, the one that I'd created a couple weeks ago, and then this one that I just created this week. So it should be under quizzes, Samantha. So you should be able to find it there. But again, I would highly encourage you to practice. Does it have unlimited retries? Yes, absolutely. It's unlimited. It's available now. It's available, I don't think I even put any limit to how long it's going to be available. So everything there is there. So thanks for the question, Arjun. I'm sure you're not the only one asking. All right. So hey Joyce. These sessions are recorded, and so if you have a power outage or anything like that, the live chat is recorded and it's also posted on YouTube. Hey Marisol, and so just so you're aware, that's all there. So the previous 2 are already posted, and this one will be posted as well. It usually takes about an hour or maybe an hour and a half after the stream ends, and then YouTube posts it automatically. Okay, so let's jump into this. So, statement of cash flows. No doubt that whenever you tackle one of these, the first few times it can be daunting. For some people, they've done simple ones in their introductory classes, but for most students, they haven't. And so we'll kind of walk through one here. Oops, sorry about that. Okay, so why does GAAP require the separate disclosure of cash flows? And really, it's this idea of having more useful information. And so when we talk about useful, there's really more than one facet or one aspect to useful as far as what that means. Content is for sure part of it, but transparency is also part of it. And so when accounting information, when they're making choices in the regulatory environment about making information useful, it's not just content, but it's also transparency. In other words, does the disclosure provide the information in a way that is helpful? And so with the statement of cash flows, people had been estimating cash flows for companies for 100 years. And so financial reporting started in 1930s, and right away analysts and people would be estimating cash flows, but yet the required disclosure of cash flows by the firm didn't come into effect until like 1988. And so it wasn't like the information was necessarily missing. It's just that by the distinct disclosure within the context of a statement of cash flows, that information became more transparent, and then also just some aspects of the content, that disclosure did provide some additional information. So it's not all content driven, but transparency was a big piece of it too. Also, current cash flows are predictive of future cash flows, and actually are more predictive than accruals by themselves. And so it's important that whenever you're trying to predict information, which is the whole point of financial reporting, is to provide decision useful information about predicting future cash flows. That's kind of going back to the conceptual framework. Those current cash flows are very predictive, and so having that information in a transparent way is important. All right, so what does the information on the statement of cash flows provide? First of all, it allows users to predict the firm's ability to generate future cash flows. Again, this year's cash flows are predictive of next year's cash flows, and so there is that predictive nature of the information. It also allows users to understand what is the firm's ability to pay dividends and potentially meet obligations, whether it be interest payments or actually repaying debt. It also allows them to understand reasons that for the difference between net income and operating cash flows. I do want to highlight a couple things real quick with that particular statement, because I think most students don't fully comprehend the difference between net income and operating cash flows. I think most people get the fact that income has both accrual and cash components. I think everybody gets that, whereas cash flows obviously don't have an accrual component. But also net income includes things like gains and losses from the sale of property, plant, and equipment. It also includes like depreciation expense and amortization expense, and all those types of items. And so, but operating cash flows don't, because the cash flows related to buying and selling long-term assets, those are investing cash flows. And so there's distinct reasons there are difference between net income and operating cash flows. So I just want to be clear that it's not merely accrual versus cash-based. There's also just things in net income that are not included in the operating section of the statement of cash flows. It does also allow users to better understand non-cash activities and financing activities. There's a requirement for a separate disclosure of that information. There are three types of cash flows. Hopefully this is not too new, but there's operating cash flows. That's the day-to-day kind of core activities, of the firm. Investing cash flows, that's buying and selling non-current assets like purchasing land or selling equipment. And then finally, financing are those cash flows from issuing or retiring the firm's debt and equity, and that also includes paying dividends. I will say one item that oftentimes students don't quite understand is that interest payments are an operating activity under the current GAAP guidance. And so even though interest payments are part of a financing sort of underlying instrument, the debt, the actual payments for interest are considered an operating cash flow, at least for now. So what is a cash use versus a cash source? This is just getting you used to some of the terms that we use in this chapter. So a cash use is a cash outflow, meaning a payment that I'm making. whereas the cash source is a cash inflow, which is a payment that I'm receiving. And so just understanding use is cash outflow, source is cash inflow. All right, so what's the difference between the direct and indirect methods for the statement of cash flows? With the direct method, you analyze specific aspects of operating activities like receipts from customers or payments to suppliers. So it really goes kind of item by item, like activity by activity. Whereas the indirect method is more of an aggregation of all operating activities together. And essentially, it just demonstrates the reconciliation between net income and operating cash flows as a whole, rather than specifying each specific activity. Investing and financing sections are both the same under the direct and indirect method, so there's no difference there. Just so you're aware, on the test, you will have to provide an entire statement of cash flows using the indirect method, and then also at least just provide the operating section, again, using the direct method. So you are responsible for both. So what does FASB require? On the test, I'm requiring the indirect method, and that's the reason why is because that's the one that the FASB also requires. And so FASB requires the indirect method. They also highly encourage the direct method. The vast majority of companies only provide the indirect method. All right, so comprehensive problems. And so most statement of cash flows for intermediate 2, the big piece is basically solving a comprehensive problem. And a lot of students ask, why do we do this? I'm not going to ever do this in practice, in the real world. And that's absolutely true. Odds are you're never going to create a statement of cash flows from scratch. However, there is a skill that creating a statement of cash flows, just the skill of doing that, it's demonstrating something that's difficult to demonstrate in other contexts. And basically what the statement of cash flows requires that you do, it's that you bring in all of this information, a lot of different connections between different financial statements and information to create this statement of cash flows. And one thing that we want you to demonstrate in Intermediate 2 is this familiarity with how all these accounts and financial statements interplay. And so the statement of cash flows really forces you to connect those dots in a way that we really haven't done before. And so there's value in creating a statement of cash flows from an academic perspective and just demonstrating knowledge, even though as a practical matter, you're really not going to create one. Now, I do think there's a secondary benefit though, and that's by creating a statement of cash flows, whenever you look at a statement of cash flows, you'll kind of understand how it fits a lot better than if you just looked at it by itself without ever actually creating one. So there is this level of familiarity that you're going to gain by creating a statement of cash flows. And so I think there's a lot of benefits to doing a comprehensive problem. All right, so again, it requires all of your accounting knowledge, and you have to understand balance sheets and income statements and how they're all related. So it's a big sort of test of your knowledge. The other thing is you cannot memorize this example or any one specific example and think that it's sufficient. It's really that the repetition and multiple examples, you're developing a skill set. And so it's like if you've ever done like an algebra problem, like they do these, multi-factor, sort of simplifying, a squared plus, xy, plus 2c squared over, some other, long thing, and what you're trying to do is simplify. And so the more of those you do, the better you're able to simplify using algebra. But then, of course, when you have a test, it's never exactly like any one that you've seen. It's just a matter of you've developed the skills or the methods to do it so that no matter whatever problem you're given, you'll be able to solve it. And so that's the same thing here. The problem that you're going to get on the exam is not exactly like any of the problems you're going to get to practice with, but through all of those practice problems, you'll have the skill set you'll need in order to solve the exam problem. Hopefully that makes sense. All right, again, we're developing a method. All right, so creating a statement of cash flows requires you process and understand several things. First of all, you do need to understand comparative balance sheets. The income statement, you have to kind of understand the accrual and the cash components. You have to think about individual account transactions. And then the last thing is take that information and create a consistent and repeatable approach to attack each problem. Usually, the vast majority, and I cannot think of a better way to do it, but you calculate cash flows from operations first, then transition into the investing section, and then finally finish with the financing section. And so those last two steps with the indirect method also require that you analyze individual transactions. So just be aware that's where that information is going to play a greater role. Okay, so this is the problem, the practice problem that's on Canvas. And so what we're doing here is I've given you information. The formatting is a little bit different because it's PowerPoint slides rather than an 8.5 by 11 sheet. But I just wanted you to be aware. Basically I just put the assets next to the liabilities and equity just because space. But everything else is essentially the same. Hopefully it looks the same. And so we're going to kind of jump into this and walk through how we approach one of these comprehensive examples. Just so you're aware, I am going to post these slides afterwards. I know Arjun had asked about previous ones. I'm going to do the same here. This particular slideshow, I think it's like 160 slides. Don't be intimidated by that. It's just for the transition and doing the live stream, I had to create some things with the slides just to help you see it a little bit better. But it's a lengthy presentation, just so you're aware. Okay, so statement of cash flows. So the first thing is at the very top. I want you to notice that the statement, the company name at the top, the statement of cash flows is the second line, and it's always for the year ending. In this case, the year ending 12/31/2020. And I want us to compare that to the dates on the balance sheet and the income statement. Notice that the income statement is also for the year ending, whereas the balance sheet is as of. And that really is because they are different types of statements. The income statement is a flow. It's revenues over the year. It's not at a point in time, it's during the year. Whereas the balance sheet, it's just what is the balance on this date. And so that's why we have the different formatting for the dates, and as of for the balance sheet, and for the year ending for an income statement. The statement of cash flows is like the income statement in that it's kind of accumulating cash flows over a period of time. It's not a point in time, it's over the year. And so that's why it's for the year ending. In your solution on the test, you need to format the date correctly. It needs to say for the year ending, or for the period ending December 31st, 2020. Easy points, but points you could miss if you don't do it correctly. All right, so we start with the cash flows from operations. And so what we're going to do here is I'm going to kind of show you sort of how we walk through it. And so with this cash flow from operations, you start with the income statement, and then you transition to the balance sheet when we're using the indirect method. And it's actually true with the direct method as well. But we go sort of, the way I always think about it is we go from the income statement through the balance sheet to the cash flow. And so as we're transitioning through, that's the way that I always think about it, from the income statement through the balance sheet to the cash flow. And so let's start by looking at the indirect method, and we start with net income. And so the net income is that bottom line number, and we start again with the indirect method. We're going from net income and we're reconciling net income to the operating cash flow. And so that we start with net income, which is $325 for this example. The next step then is to take non-cash, non-operating expenses and add them back. Or if there's a gain, it'd be subtracted from. So in other words, we're trying to take the non-cash items, the non-operating items, and remove their effects on net income. And so as an example with depreciation expense, that's an expense, so it's a reduction to income. And so if I want to undo that effect in order to get to a cash flow, I have to add the depreciation expense back. And so that's why I start with net income and then I add depreciation expense, $120, to my net income number. Similarly, I add back the amortization expense. Again, that's a non-cash, non-operating item. And then we transition down to our non-operating items, gain on sale for the equipment, for the building, and for the land. And so I kind of combine the two gains together just to keep it simple. You don't have to combine them. I just did to keep it simple. And so in this case, again, the gains are increases to income, and I want to undo that effect. And so Zuli asks, just to clarify, cash flows doesn't include things like depreciation or amortization. Correct. it does not include those items. So we have to remove their effects, just like we're removing the effects from the gain on sale and eventually here in a second on the loss on sale. And so the gains on sale, we're adding those back because we're trying to remove the effect of those gains. And then finally, we want to remove the effect from the loss as well. Again, a loss is an expense, and so we're going to add that back. And so again, you have to look at an income statement and say, okay, what are those non-cash, non-operating items? When I say non-operating items, I want to be clear. I don't mean operating section. I mean, in the context of a statement of cash flows, those things that don't deal with operations. And so depreciation and amortization, those deal with non-current assets. And under the framework of a statement of cash flows, those are investing activities. And so we need to remove their effects. And of course, they're also non-cash. I'm going to pause there for a second in case there are any other questions. Okay, so now we have to transition. Again, we go from the income statement through the balance sheet to the cash flow. And so now what we have to do is we have to reconcile, and there's really, the way I think about this is there are sources and uses of cash through our operating activities that don't show up on net income. And what I mean by that is if I'm better able to manage my receivables, that's going to free up cash. But handling my receivables doesn't change whether or not I made a sale. And so this is a sort of a source of cash that doesn't show up in net income. Yet it does affect our operating cash flows. And so what we're trying to do is walk ourselves through all the different items on the balance sheet that deal with operations where you could either have an additional source of cash or a use of cash depending on how you're handling that item. And I will say very quickly, those items are going to be found as current assets or current liabilities, but I also want to be clear, especially on the liability side, not all current liabilities deal with operating activities. As an example here, you can see dividends payable and short-term notes payable. Well, dividends payable is a financing activity, and so is short-term notes payable. And so those two items would not be included, even though they are current liabilities. So we can't say all current assets and all current liabilities, but when we're talking about these sources and uses of cash that get us from net income to the actual operating cash flow, it's those current assets and current liabilities that's where we're going to be looking. And so the first place we're going to look is our accounts receivable. Now, what I've done here is there are two accounts that really deal with our receivables. There's the gross number, which is the account receivable account balance. And then there's the allowance for bad debt expense, or sometimes it's the allowance for doubtful accounts. At times I've abbreviated it ADA, which again is just the allowance for doubtful accounts. It's a contra asset. And what it basically says is I have some receivables, but I believe that I'm not going to collect all of them. And so we have this balance to offset the amount of uncollectibles that we might have. And so there's sort of two approaches. You could take each item separately, but what I do is I just combine them. And so if you kind of think about the 2019 net receivable, the net receivable is 135 in 2019, which is 145 minus 10. And then in 2020, the net receivable is 175, which is 190 minus 15. And so the change in the net accounts receivable goes from 135 to 175. So there's an increase. And so we have to think about what the effect is as far as is that a source or a use of cash. And what it's saying is I'm making sales, but my receivables are staying outstanding. So what's that do? Well, that consumes, that uses my cash. Rather than having that cash in my hands, it's in my customers' hands because they're not paying me. And so that's a decrease to my cash flow relative to what I've reported as net income. And so again, if you kind of think about it, it's kind of an opposite. So an increase in net receivable is a use of cash. So it's decreasing my cash flow relative to what I've reported as net income. And so with inventory, in this case, notice that we start with $200 of inventory and then we're left with $130. Well, what does that mean? It means that I'm not leaving my inventory on my shelves. And so that's a source of cash. So that I'm better able to manage my inventory. That's a source of cash. And so that's a positive. That's an increase to my cash flow relative to what I've reported as my net income. The better I manage my inventory, the more cash that's going to free up. Prepaid rent, the increase to prepaid rent, again, that's a use of cash. And so, again, I'm prepaying more rent. I'm making those payments, even though I don't record the expense until I actually occupy the space and use it. But I'm prepaying more of it. And so that's a use of my cash. And then finally, I'm buying more supplies, another use of cash. And so you notice that with every single one of those current assets, if there's an increase to the current asset, the adjustment or the sign on the adjustment is the opposite. So the increase in AR is a negative, the decrease to inventory is a positive, and the increases to prepaid rent and supplies are also negatives. And again, that's the idea that those are sources versus with the inventory, it's a source of cash, but with the other three, it's a use of cash. All right, now we jump over to the payables. So we have accounts payable, and again, I think just walking through how to think about it, accounts payable, those are payments I'm making. That's what I owe my suppliers, as an example. And so what's happening here is my accounts payable balance is going down. What does that mean? Well, it means that I'm making more payments. That's a use of my cash. And so even though the amount of inventory that I sell or the supplies that I use doesn't change, the fact is now I'm paying down those payables, and so that's an additional use of my cash. And so Natalia says, I'm noticing that we are stating if there's a decrease or increase in the statement of cash flows. I'm not exactly sure. Well, we're increasing. When I say increase in the net AR, I mean the change in between the comparative balance sheet. So it's the balance sheet change is what we're identifying, and then the effect as far as the reconciliation from net income to the cash flow, you can see it kind of has an opposite effect depending on whether it's a source or a use of cash. Hopefully that answered the question, but I'm not sure. If I didn't, just ask it a different way, or we can always talk offline. But in this case, with the accounts payable, if I'm paying down more, that's an additional use of my cash. Whereas salaries payable, it's the same way. I'm paying it down more. That's a use of cash. And then my unearned revenue is also a use of cash. I do want us to just be aware that if it had increased, then that would be a source of cash. So as an example, if I have customers that allow me to owe them longer, well, that's a nice source of cash, because now the cash is in my pocket instead of in their pocket. And so again, I'm using this term source and use of cash again to try to get this idea of how do we go from net income to our operating cash flow. So then we add everything up. And so we're going to kind of take our formatting here, and we're going to add everything up, and we get $400. And so how do we, or what term do we use to describe a positive $400 cash flow from operations? And we say it's cash provided by operating activities. We're going to be a little bit picky in that cash provided by operating, or especially the cash provided by, that's a very common way to term those that the ultimate source of cash from operating activities. You call it cash provided by. And so on the test, you do need to format that description correctly. It's cash provided by operating activities. If it had been a negative cash flow, it would be cash used by operating activities. So it's either provided by or used by. The majority of the time, the vast majority of the time, if there's positive net income, you're going to have cash provided by operating activities. You're going to have positive cash flows. And of course, that's generally what you want. You want your day-to-day operations to produce positive cash flows, because if they're not, then you're going to have long-term problems. And so generally speaking, you want to see positive cash flows. Okay, so now we're going to jump to the next section, which is cash flows from investing activities. So when we talk about investing activities, first of all, it's again putting together a little bit of a puzzle here, more so than the operating section. You start with the beginning balance of whatever account you're thinking about, land, equipment, whatever it might be. You analyze transactions for additional information, and then you calculate an inferred balance. So that's kind of the first three steps. You have the beginning balance, you analyze transactions to try to get additional information, and then you have some sort of inferred or implied balance in that account. You compare that balance to the actual balance, and then from there you can understand if there's any implied cash-related transaction for that item. Now, the reason why students sometimes struggle with the investing and financing activities section is because this is it's something that you have to build intuition. So in other words, you have to kind of map it out, and then you have to kind of infer what happened. And so the idea behind all of these problems is that unless there's some description, it's a cash transaction. And so I'll even say that explicitly on the test. I'll say, all of the transactions are cash transactions. And so all we're trying to do here is for you to kind of reconcile what you observe, what you should observe, with what you actually observe. And then through that sort of skill building, you can understand, oh wait, there must have been a purchase here, or there must have been another sale here. Again, some examples will probably help it, but this is really where that puzzle building comes into play. All right, so the additional information that would be provided on the test, I just kind of outline it here. So I have a depreciation expense, some trademark amortization. They purchased some land, issuing a bond, and then sold some land that had a cost of $85. They sold some equipment. They also sold a building. And they purchased some new equipment and also purchased some new building, one by issuing a note, the other one by issuing common stock. And then they retired a bond and issued some common stock for cash as well. So this is just additional information that you'd be given on the problem. And you basically have to take all of this information and work your way through the problem itself. Okay, so when we're talking about investing activities, our focus needs to be on those non-current assets, and I've boxed them in red here. These are the non-current assets: the land, the equipment, the building, the patent, and the trademark. The accumulated depreciation isn't necessary for this particular problem, but it is also provided there. I know on my other example on YouTube, you actually need that information, and so it's a little bit different. But in this case, we're good with just the main account balances. Okay, so we're going to start with the land. So they purchased $75 of land by issuing a bond, and they also sold some land that had an original cost of $85. And so again, we're building our cash flows from investing, and we're analyzing our land account. We start with that beginning balance of $800. And of course, we're told that we purchased some land by issuing a bond. And then we had sold some land that had an original cost of $85. But I want to make a distinction here that the cost does not mean that's the cash that we received. So how do we know the amount of cash that we received? We're going to analyze this sale. So we had the land cost of $85. And then we have to look at the income statement. And we have to look, okay, when we sold that land, was there a gain or was there a loss? And in this case, we see that there was a loss on the sale of land. And so we take that information. So we know there was a sale. It had a cost of $85, and we also had a loss on the land when we made the sale. So what does that mean? So we had the land cost of $85. We sold, the sale had a loss, which means that the cash we received must have been $65. And so that's the first part of our cash flows from investing. The cash received from the sale of land, $65. And so from that information, then, we should observe an account balance in our land account of $790. In other words, if this is the only thing that happened, if these two things, if that's it, then we should have a balance of $790. But actually, our balance is $845. And so given there's a difference between our actual balance and our implied balance, it means there must have been a cash purchase of $55. So Zuli asks, why do we have, why the bond purchase? And so just understand, whenever we buy land, even if it's not with cash, if we're using a bond, it's going to change our land account balance. And so we made this purchase by using a bond. So we issue a bond, and with that issuance, we're able to get some land. And so that's going to increase our land account balance by whatever the bond amount is. And so in this case, that was 75. And so that's why we add it. So at the end of the day, we have our implied cash purchase of 55. And so, again, unless otherwise stated, we assume everything's cash, and so that means we must have paid for that purchase. And so that's a negative. That's a use of cash of $55. And so we have fully analyzed our land account. So the next thing we're going to look at is the equipment. 49 received $25 on January 1st for equipment that it sold. The equipment sold had accumulated depreciation of $40. 49 purchased some new equipment by issuing a $35 note. And so that's the relevant information, additional information for the equipment account. All right, so again, just like we had done before, we're going to analyze our equipment account. We start with the beginning balance. We're told that there was a sale of equipment for $45, and just going back up, let's see. I don't know why I said it that way. I should have waited. Okay, so I gave away the farm a little bit. That the cost is going to end up being $45. So I didn't intend to do that, but we'll see how I got that $45 here in a second. And so the cash that we received was $25. That was given in our additional information. And then from there, we know there was also a gain on the sale of equipment. And so that gain on sale means that there must have been a book value from the equipment of $5. So if I received $25 cash and I'm told that I had a gain, that means the book value of the equipment that I sold must have been $5. So that's kind of how you put together that puzzle. But we also are told that there was accumulated depreciation of $40. And so if the applied book value is $5 and the accumulated depreciation for the equipment that I sold was $40, then it must be that the cost of the equipment that I sold was $45. And so when we talk about the equipment account, it's going to change based on the cost of the equipment that was sold. And so in this case, the cost of the equipment that was sold was $45. And so that's what's going to change the account balance. Again, I gave away the farm a little bit by disclosing the cost ahead of time, but hopefully now you see where the cost came from. So you have to put together that information. But also, of course, I was given the cash that I received, and so the cash received from the sale was $25. And so that's kind of the first part of analyzing the equipment. And we also were told that they purchased some equipment by issuing a note. And so putting all that information together, we know that we should observe a balance in our equipment account of $155. We actually observe an account balance of $210, which means there must have been a purchase. And again, by assumption, given there's no other information, it must have been a cash purchase of $55. And so cash paid from the purchase of equipment, or for the purchase of equipment, however you want to say it, was $55. All right, so let me stop there, see if there are any other questions about the equipment account before we move on to the building. Okay, I'm not seeing anything yet. All right, so now the building. Original cost of $200. $125 of accumulated depreciation, and they also purchased $75 in the building in exchange for common stock for the test. So we expect this level of difficulty for the cash flows problem. Yes. It may not have as many different moving parts, but this is similar as far as the level of difficulty you should expect. These problems are tough. It's 50 points. Okay, so all right, so now we have this additional information related to the building, and we're going to use that information to analyze the building account and to figure out the cash flows related to the building. All right, so again, beginning balance, $750. We're told that the cost of the building that was sold was $200, but again, we have to sort of reconcile the fact that the cost is not necessarily the cash that I received. This one's a little more involved because unlike land, a building does have accumulated depreciation. So there's a little more involved here. So again, the cost was given as $200. The accumulated depreciation was also given as $125, which means the book value for the building that was sold was $75. And so at the time of the sale, the book value of the building was $75. We analyzed the income statement to see if there was a gain or a loss, and in this case, we are told that there was a gain on the sale, and that the gain on the sale was $60. So we take that information, we have the book value plus the gain gives us the cash received. And so we must have received $135, and now we include that in our cash flows from investing section of the statement of cash flows. We're also told that we purchased a building with $75 of common stock, which means that if this is all that had happened, the balance in the building account should be $625. We see that the actual balance is $780. And so again, I got a little ahead of myself on the ordering here, but that means there must have been a purchase for a building of $155. And again, by assumption, since nothing else has been said, that must have been a cash purchase. Again, I'm going to pause here in case there are any questions. But again, hopefully you're starting to see the rhythm of how we have to work with these accounts. Beginning balance, think about what's happened, get an implied balance compared to the actual, and then figure out if there's an implied purchase or an implied sale. Okay. So next we have the patent and the trademark, and I highlight the comparative balance sheet and the income statement, just sort of getting to a basis of knowledge that you need to have. And so first of all, patents and trademarks both are amortized. The other thing is when the amortization of those accounts, it goes directly into the account. And so whenever we amortize a patent or a trademark, there's a direct reduction to that account. And so what we see is we have an amortization expense of $25, but we have two items that are amortized, which means that the amortization expense in part reflects the amortization of the patent and in part reflects the amortization of the trademark. So this is an important basis of information we have to have as we try to understand the cash flows related to the patent and trademark. And we're going to kind of work with these in conjunction. And so with both of them, of course, we have our beginning balance of $145 and $45. We are told that the trademark amortization expense was $20. And so when we bring that information over, we see that the amortization for the trademark was $20, but total amortization was $25. And that means that the patent amortization must have been $5. And so we can bring that information into analyzing our two accounts. So the trademark had $20 of amortization, the patent had $5 of amortization, and so for each of them we have a new implied balance of $125 for the trademark and $40 for the patent. We compare those implied balances to the actual balances, and so we can see the trademark had a $200 balance and the patent had a $65 balance, and so in both cases there's an implied purchase. For the trademark, $75, for the patent, $25, and of course we include those in our cash flows from investing. And so that's completes the different items, because now we've worked all the way through our our non-current assets. All right, so now we have our cash flows from operations. And normally speaking, there'd be kind of a north-south sort of formatting where the cash flows of operations would be on the top and then the investing activities would be below that. But obviously, given the space that I'm trying to work with here, I couldn't quite fit it. And so we're just going to kind of go left to right so you can see everything. When we kind of add up those investing cash flows, you can see it's a negative $140. And as we previously discussed, then that means that's cash used by investing activities. I guess cash provided by is a positive cash flow. Cash used by is a negative cash flow. The other thing I want to highlight here with the investing activities, generally speaking, having a negative cash flow is what we would expect. Because what that means is I'm using cash, I'm investing in non-current assets rather than liquidating my non-current assets. Obviously, if we're liquidating a bunch of non-current assets, that means we have fewer non-current assets to operate the company with. And so generally speaking, we would want to observe negative cash flows with our investing activities. Again, I'll pause there in case there are any more questions, and then I'll move on. So how we got the patent. Let me go back a little bit. All right. So again, the patent, the beginning balance, hopefully that's obvious. The amortization, just remember, the total amortization expense was $25. And so with the trademark, we were given that the amortization for the trademark was $20. And so since the amortization for the trademark was $20 and total amortization was $25, it means that the amortization for the patent must have been $5. And so the approach then is the same from there, that we subtract the amortization from the beginning balance, and from that we get an implied balance, $125 for the trademark and $40 for the patent. And then we compare that to the actual balance. In the case of the patent, the actual balance was $65. Well, that means there must have been a purchase of $25. And so that's why we have the cash purchase for the patent of $25. Hopefully that makes sense. Um, so Zuli says, in our package problem, we have an implied balance and an actual balance, but for some reason it doesn't go on the investing cash flows. We'd have to talk about that one because I'm not sure exactly which one that you're talking about. If they're the same, then that means there is no purchase. So if your implied balance and actual balance are exactly the same, then there would be no cash flow because there's no difference. I think that might be what you're talking about. I'm hopeful that's what you're talking about. Ah, there we go. Yep, that was it. Okay. All right, so then we kind of get this. And now we move on to our financing section. All right, financing activities, again, similar to the way we've dealt with our investing activities. We start with the beginning balance. We analyze transactions and that additional information. We calculate an inferred balance, compare it to the final balance or the actual balance, and then see if there's some sort of implied cash-related transaction for that item. I will say the other sort of added wrinkle to the financing activities is understanding dividend payments. You do need to look at those within the context of retained earnings. And again, once we walk through the example, hopefully that will make more sense. All right, so again, we have all of these different financing activities: dividends payable, short-term notes payable, bonds payable, common stock, and retained earnings. Now, retained earnings, I want to be a little bit careful. There's really not a direct financing activity within, like, inherent to retained earnings, but we do understand that the dividend payments affect the retained earnings account, and so that's where we're going to be using that information. It's really using it to get to the dividend payment. All right, so we're going to start with the short-term notes payable. We're going to save the dividend for the end. The short-term notes payable, the beginning balance is $145. If we go back to our additional information, we are told that we purchased new equipment by issuing a $35 short-term note. And so what that means is the short-term notes payable balance went up because we issued it to buy some equipment. And so if nothing else happened, then the implied balance would be $180. The actual balance was $35, which means there must have been the retirement of a short-term note payable. Now, we use the term retire to mean pay off. So whenever you pay off a note or pay off a bond, that is a bond or a note retirement. And so it's really important that you use that terminology. So you retire notes or you issue notes. Those are the two things that you do. You retire them or you issue them. The same thing is true with the bond. You either retire bonds or you issue bonds. With common stock, you either issue common stock or you repurchase common stock. With repurchased common stock, remember, it can be held in treasury. It doesn't mean that it's necessarily retired. And so again, with debt, it's issue or retire. With common stock, it's issue or repurchase. And so with the short-term notes payable, we retired a short-term note payable for $145. All right, so now we're going to look at the bond account. Told we purchased some land by issuing a bond and also retired a $125 bond. So there's two bits of information we're going to be able to use here. We have our beginning balance. Again, the same approach as always, $450. We're told that we purchased with some land by issuing the bond, so that's going to increase the bond payable account balance. And we're also told that we retired a bond for $125. That is a cash flow, so that would be included in our cash flows from financing. Again, it's a use of cash of $125. If that's all that had happened within the bonds payable account, then we would have a balance of $400. The actual balance is $630, which means there's a difference of $230. And again, just to remind ourselves what that means. And so just kind of in your mind or out loud or in the chat, tell me what that should say. It's going to say something in that missing blank. And so try to figure out what it should say right there. See if anybody gets it. And the answer is there's an implied issuance. There you go, Ryan. Good job. Matthew also got it. So there's an implied issuance of $230, which means that we issued bond payable for $230. And that is a source of cash. So it's a positive cash flow. Good. Dylan got it as well. All right, so here we go. Next we have common stock. And so the 49er purchased $75 building in exchange for common stock and also issued $185 of common stock for cash. And so we're going to kind of go a little more lockstep here and see if you guys can kind of stay ahead of me a little bit. Again, with the delay, sometimes it gets a little confusing for me as far as like when you see what you see, but let's kind of walk through this. And so we have beginning balance of $1,350, and there's going to be two items that we're going to sort of add to that beginning balance. And so if you can, in the chat feature or out loud to yourself, what are the two items that are going to be included there? So again, we're just going to try to, and maybe I'll give you try to work through it as far as you can, honestly. Like even if you can go beyond just those two items, maybe on a scratch sheet of paper or something like that, figure out what you think happened with the common stock. So there's, again, two potential things. There's the issuance of common stock, and then there's the repurchase of common stock. And see if on your own you can kind of navigate that. I'll kind of look at the chat. Once you feel like you got an answer, just say, "Hey, I got an answer," or just so I know that a few people are kind of able to get to something before I move on. Yeah, so the issuance for 185. Dylan says he can't remember the other piece on the previous slide. Here, let me pop back up. So just kind of give you a reminder. I highlighted it there in the gold. Does anybody have an answer yet? Give it another minute here or two. All right, Matthew thinks he's got it. Something. That's good. Okay. Yep. Dylan, I think, has got it there. Natalia, repurchase 75. Zuli, repurchase 85. Joanna, implied issuance of 65. Let's see how we're doing so far. So we have some disagreement on the repurchase. Let me pop back up and show you what we have there. So Matthew says issuance of 185 and repurchase of 85. All right, starting to trickle in here. All right, so let's see what we got here. Of course, we do have the building purchase, which is going to increase the common stock account balance. And then we have the issuance of 185. So hopefully we got the issuance of 185. So Matthew got that. That is a cash issuance, and so that is going to be listed on our cash flows from financing activities. So we have an implied balance of 1,610, an actual balance of 1,525, and $85, and that is the implied repurchase. So repurchase common stock, $85. So hopefully Natalia and Joanna, hopefully you guys figured out what you may have done wrong. May have flipped a sign or just had a number wrong or something like that. Okay, so that's dealing with the common stock. We issued common stock and we repurchased common stock. So now the last part of it, which is the dividend. Now, I'm going to tell you right now, the dividend is usually the one that on its face you're probably most familiar with, but you may forget some details. And so just pay attention. There's some important little details with this. First of all, there are three items that we have to kind of navigate through in order to understand what we paid in dividends. We know we have to think about the retained earnings account, we have to think about net income, and we have to think about the dividends payable. So those three items in this particular example are all necessary for us to get to the cash that we actually paid for our dividends. So we start with our by focusing on a retained earnings account. And our beginning retained earnings is $355. Now, hopefully in your principles class, you did a statement of retained earnings. And so hopefully with that statement of retained earnings, you can start to understand how this might all fit together. And so you have your beginning retained earnings, you add your net income to beginning retained earnings, and that gives you an implied retained earnings account balance. Now remember, retained earnings increase with income and they decrease with dividends. But I want to be very, very clear about what type of dividends. So let's kind of get there here in a second. But our actual retained earning balance is $635. And so there is this $45 reduction to our retained earning balance. Now hopefully we all understand that deals with dividends. But I want to be very, very clear. It's dividends that are declared. So whenever there's a declared dividend, that's what impacts the retained earning balance. It doesn't require that the dividend actually be paid. It just has to have been declared. If you remember back to, I think, chapter 15, where we did the journal entries, the second they declare that dividend, that's when we would debit retained earnings. And so that's the same idea here, as the declaration is what reduces retained earnings. That may or may not be the amount that was paid. Well, how do we figure out how much was paid? We have to look at the dividends payable account. So we have our beginning dividends payable. So basically at the very beginning of the year, we already owed $20. If we declare another $45 dividend, then in total we would owe $65. The only way that we wouldn't owe $65 at the end of the year is if we made a payment. And so we compare the implied payable account balance to the actual. So our implied balance is 65. The actual balance is 10. Well, what accounts for that $55 difference? Well, it must have been that's the amount of dividends that we actually paid. And so you can see with the dividend, there's a lot of moving parts here. There's the retained earnings account. There's net income. There's understanding what you declared versus what you paid. And so in this particular case, because we have dividends payable, there's just a little bit more of a complication to it. I know in some of the other example problems, there is no dividend payable account. If there's no dividend payable account, it means whatever has been declared was also paid. Again, I'm going to stop here for a second in case there are any questions. I know there's, again, about a 10-second delay, and it might take you a few seconds to type out any question you have. So I'm going to kind of meander a little bit. Again, the delays aren't optimal, but it's no way to get around it. Okay, I think we're all right. Okay, so we've continued to build out our statement of cash flows. We add it all up, which is the $5, and that's a positive number. And so just real quickly, either in the chat or in your own mind, we're going to kind of say, okay, what would we state, or what term would we use in that blank? And I'm sure the 2 to the left should give you a clue. But again, if you want to put it into the chat, or just say it out loud to yourself, go ahead and do that. So in your mind, have something in mind. This is what I would say. If this were my problem, this is what I would type in. And the answer is cash provided by financing activities. Cash provided by financing activities. Good, Natalia. I say, Dylan, it's a financing activity, so you had to switch that. You got the provided by correct, but it's financing. Matthew, good job. Ryan, good job. Marisol, good job. That's all right. All right. Good job, everybody. All right, so now we have to complete it. So those are the main 3 sections, but the statement of cash flows is actually not done yet. And so the next section that we have to do is start working down the rest of the statement of cash flows. And so the next section really is reconciling the beginning cash balance to the ending cash balance. And so this is a disclosure on the statement of cash flows. So you have your beginning cash balance. You sort of combine all 3 activity sections into one aggregate cash flow. And so in this case, we had the positive operating cash flows of 400, the negative cash flows from investing activities, which would sort of be a subtraction, and then positive cash flows from financing activities. And so in total, our cash flows were $265. And so our ending cash balance then is $780. And if you think back to the balance sheet, that is the ending balance. I think it's gonna come up again here. I don't think I built it in right here. I should have, but I didn't. But our ending cash balance is $780. And then the other thing you do have to disclose is significant non-cash activities. For the test, I require this disclosure in the statement of cash flows. And so any item that was talked about in our additional information where it was a non-cash transaction, it must be disclosed here. And so the land purchase, the equipment purchase, and the building purchase, each with either a bond, a note, or common stock, those are all significant non-cash activities. In practice, there's a couple differences. One, there is some judgment as far as whether a particular activity is significant. For our purposes, if it's listed, it is by default significant. But in practice, there is judgment about whether or not that should be disclosed. Second of all, in practice, it does not necessarily have to be included in the statement itself. It is permissible to have a separate disclosure in the notes or some sort of separate table in the notes rather than including it on the statement of cash flows itself. For the purpose of the test, though, you do need to include it in the statement itself. It is a required disclosure for the purpose of the test. Okay, so now we're going to transition to the direct method. So we have our full statement of cash flows using the indirect method. Now, just like the test, we're going to reproduce just the operating section using the direct method. So again, just to reiterate how it's different under the direct method, they classify operating cash flows by activities, and the investing and financing sections would have been the same. So Zuli asked, how did you get the change in cash without knowing ending cash flows? Well, remember, we have all three sections here. We have the operating activities, we have the investing activities, and we have the financing activities. Those three together, those are all the cash-related activities for the company. That's it. There's nothing else. And so when we add those three up, that gives us our total change in cash, $265. Now, on a test, you might calculate that, and all of a sudden, when you do so, it doesn't match the ending cash balance. When that happens, that means you've done something wrong. Just sort of as a test-taking 101 sort of hint, if you do that and for whatever reason the balance doesn't work out, I would first of all make sure I complete the rest of the test first. Secondly, unless you can specifically identify your error, you're probably better off leaving your work as is. Because it could be a simple calculation error. If you find it, great, make that change. But trying to figure out what small mistake you might have made, most students, when they go chasing a mistake, actually create more problems than they solve. And so I would say work through the statement of cash flows one time, sort of thoughtfully and thoroughly. If it doesn't equal out, and a lot of times it doesn't, at least the first time through, if it doesn't equal out, I would consider finishing the rest of the test first and then come back. And if you can specifically identify your mistake, only at that point should you make any changes. Otherwise, you might just create more problems. All right, so back to the direct method. Again, we have our income statement and our comparative balance sheet. And just like the indirect method, with the direct method, you go from the income statement through the balance sheet to the cash flow. However, in this case, it's item by item. It's activity by activity. And so rather than starting with net income and working your way across, you're actually going to be looking through each income statement item and working your way through the balance sheet to the cash flow. And so the first one we're going to be looking at is net sales, and this deals with our cash receipts from customers. Now, notice there is a sales revenue at the top, and then we subtract our returns and allowances. And so anytime you have returns and allowances, just start with the net sale in order to get cash receipts from customers. And so we start with that net sale number of $1,515. From there, we've got to figure out, okay, what are the other items that relate to my exchange with my customers? The first one is bad debt expense, and so we know that some customers will fail to pay. And so we know that is an item that relates to my interactions with my customers, and I've got to deal with that. I also have my accounts receivable account, my allowance for bad debt expense, and then finally my unearned revenue. So with my customers, there's a lot of accounts that I've got to deal with to understand, well, how much cash did my customers actually pay me? Because that's the disclosure that the direct method requires. And so we're going to take all that information, put it together to get our cash receipts from customers. So we start with net sales, $1,515. And then we have to think about our beginning accounts receivable. All right, so what does that mean? It means that a customer owed me money at the beginning of the period. When was the sale recorded for that? And so if this is 2020 and I have my beginning accounts receivable, when did I record the sale for any beginning receivable? On the count of three, it's either 2020 or 2019. So let's kind of narrow it down. So on the count of three, say a year out loud. 1, 2, 3. Well, the sale occurred in 2019. So we had recorded the sale previously. When are we going to collect, though? We're going to collect from the sale in 2020. And so the problem that we have is I had a cash receipt from the customer during 2020 that wasn't included in net sales in 2020. And so what do I need to do with that receivable? I need to add it, because I'm going from my income statement through my balance sheet to the cash flow. And so I now have this additional source of cash, right? I have this additional source of cash that isn't included in net sales. And so I need to make that adjustment. And then I have my ending receivables, and that's a negative adjustment because that's a use of cash. And the idea is I've recorded a sale during the current period, but I have not yet collected on that sale. And so that's why it's a negative 190, because that's a cash flow that I'm going to get in 2021, not in 2020. And so I need to subtract it from my net sales. The next one is a piece that some students struggle to understand, and that is write-offs. And so with a write-off, basically what that means is that I have a receivable. So I have a beginning accounts receivable of $145. Just kind of take that as an example. There may have been an account within that $145 balance that I simply wrote off. I never collected it. But it would affect that account balance. And so I got to think about what to do with write-offs, because those are items where that's a use of my cash because I never collected it. And so how do I handle that? Well, I deal with the write-off, or I figure out my write-off by looking at the allowance for doubtful accounts. And so I have my beginning allowance for doubtful accounts. To that number, I add my bad debt expense. So those are sort of the new period, or the additional accounts that I don't think are going to be collected. And then I subtract off my ending allowance for doubtful accounts, and that gives me my write-offs. So beginning allowance for doubtful accounts plus bad debt expense minus my ending allowance for doubtful accounts, that gives me the write-off. And again, the write-off is a use of cash because essentially I have a receivable that I never collected. And so that's a minus 15. And then I have my beginning unearned revenue. Again, beginning unearned revenue, that's a payment that I received in 2019 for work that I'm going to do in 2020. So I record the sale in 2020, but I didn't get the cash flow in 2020. I got the cash flow in 2019. And so I need to subtract that off because that, originally it was a source of cash, but in this case, I need to make this adjustment because I already recorded the cash flow related to that particular or those particular sales. At the same time, I'm going to receive cash payments in 2020 for work that I'm going to do in 2021, but it is a receipt that I got from my customer. And so I need to add my ending unearned revenue to my net sales in order to get cash receipts as well. So when I add them up, I get $1,450. So my cash receipts from customers was $1,450. All right, so now we continue down our income statement, and that gets us to our cost of goods sold. Now, cost of goods sold, that deals with payments that we make to our suppliers. In this particular example, there's also supplies expense, and so those are also payments that I make to my suppliers. So we're going to kind of handle these two together, just for ease of sort of reconciling these different items. And so we're going to lump them together. And so the items that we have to we have to think about here is our inventory, our supplies, and our accounts payable, because all of these will deal with payments that we make to our suppliers. And so we're going to take this information and we're going to get to the payments that we make to our suppliers. And so we're going to start with our cost of goods sold number, and of course we begin with our beginning balance. And then we got to think about, we have our beginning and ending inventory. Now in the chat or on your own, I kind of go back to the numbers. So our beginning inventory is $200, our ending inventory is $130. And so you need to figure out, what adjustments do I need to make to my cost of goods sold number in order to go from cost of goods sold, which is on the income statement, through the balance sheet to the actual cash payment. So with beginning inventory, there needs to be an adjustment, and with ending inventory, there needs to be an adjustment. And you need to ask yourself, do I add it or do I subtract it? Again, in the chat feature, if you can communicate what you think ought to be done, I think you'll learn more by making a commitment. So make a commitment, put in there what you think should be done to beginning inventory and ending inventory as an adjustment to cost of goods sold in order to get to the cash payment that I'm going to make. I'm going to give it a few minutes and figure out if we get some responses in the chat. Nobody's committing yet. Oh, there we go. Subtract the beginning and add the ending. Subtract the beginning and add the beginning. So Arjun and Matthew agree. See if anybody else chimes in. Joanna, subtract the beginning, add the ending. Yep, same thing for Joyce. Subtract and add. Good job. Anybody else going to chime in? Alright, that is correct. So you subtract the 200 and add the 130. Again, the idea here is that any beginning inventory, I would have paid for it already. And so when I sell it, it's not a cash flow for the current period. And with ending inventory, that's inventory that I've bought now, but I'm going to sell in the future. So there's been the cash payment, but I haven't sold it yet, so I had to add it too. So good job. Now let's have the same idea with accounts payable. Now, with accounts payable, conceivably, you don't know if that's a supplier dealing with the supplies expense or a supplier dealing with inventory. I'm just making a choice on where to put it. Ultimately, it's going to give me the same answer. Whether I put the accounts payable in suppliers of inventory or suppliers of supplies, I'd get the same answer either way. I'm just putting it in inventory because it's more common to have it there. So let's talk about our beginning accounts payable and our ending accounts payable. Same kind of deal here. We're going to say, are we adding or subtracting our beginning and our ending accounts payable? I'm going to kind of go back up to the numbers. The accounts payable, the beginning balance was 85, the ending balance was 70. So we're going to kind of get back to those numbers and figure out what we should do. Again, I'm going to give it a few minutes and see how many can chime in with an answer. Add beginning, subtract ending. Add beginning, subtract ending. Add beginning, subtract ending. Add beginning, subtract ending. I'm seeing a trend here. Yep. Good job, everyone. Add the beginning, subtract the ending. Again, the idea with an accounts payable, that is inventory that sort of came on my books that I didn't pay for yet, and so I'll pay for that in the current period. And then with any ending accounts payable, hey, I got inventory, but I haven't paid for it yet. I'll be paying for it in 2021. So again, add the beginning accounts payable and subtract the ending accounts payable. So the total payments related to suppliers of inventory is $665. We're going to go through a similar drill with suppliers. We start with our supplies expense of $35. And then again, we have to think about what are we going to do with beginning supplies and ending supplies. And so I'll go back up real quick. The beginning supplies is $5. The ending supplies is $15. And we just got to figure out, are we going to add or subtract the beginning supplies or add or subtract the ending supplies? Again, we're going from the supplies expense, which is the income statement item, to the cash that we actually paid for supplies. Again, I'll give it a few minutes and figure out what we have here. Anybody gonna chime in? There we go. Subtract beginning, add ending. Subtract beginning, add ending. Subtract beginning, add ending. Subtract beginning, add ending. Good. Very consistent. Very consistent. You guys are doing well. All right. Yep. Subtract the beginning, add the ending. Hopefully by now you're starting to see the pattern. The idea of supplies. Beginning supplies are those that I purchased in the previous period. Ending supplies are supplies that I purchased in the current period but have not yet used. And so that's why I subtract the beginning and add the ending. And so our total payments to suppliers of supplies is $45. And so when we add them together, total cash payments to suppliers is $710. $710. Okay. So now we keep moving down with our operating expenses, depreciation, amortization. Don't have to worry about that. We do need to think about our salaries expense, and simultaneously we're going to handle our rent expense. And so the reason we're going to do that is just because honestly they're similar. And so, but there's a really important slight difference between the two that I love to talk about. So we're going to kind of do those in tandem as well. Again, we have the items from the income statement and then their related items on the balance sheet, the prepaid rent on the asset side and the salaries payable on the liability side. And so the reason why I really like this is because one expense deals with an asset and the other expense deals with a liability. Remember, we go from the income statement through the balance sheet to the cash flow. And so that's what we're going to continue to do here. Slightly different examples though, so it's a good comparison. So in both cases, we start with our rent expense or our salary expense. When we're talking about cash payments for rent or cash payments to our employees, we start with that beginning balance, or sorry, not the beginning balance, the rent expense or the salary expense, the income statement item. And then we got to think about what do we do with beginning prepaid rent and ending prepaid rent, and what do we do with beginning salaries payable and ending salaries payable. And so again, what we're going to do is I'm going to leave you some time to think about. I just want you to give me the cash payments for rent calculation that you get and the cash payment to employee calculation that you get. So I'm going to give it a few minutes, and I want you to put it in the chat. I want you to make the calculation, do what you think is right, and then put it in the chat. I'm going to bounce back to the income statement and balance sheet so you can see the numbers. So the beginning balance for the prepaid rent is 10. The ending balance is 15. For the salaries payable, the beginning balance is 35, and the ending balance is 30. So again, those are the beginning and the ending balances. Again, we have our salaries expense, we have our rent expense, and our beginning and ending balances. We're going from the income statement item through the balance sheet to the cash flow. And so as soon as you're able to calculate one, put it in the chat, and then move on to the other one, and put that one in the chat. I think I'm going to leave it on this sheet because it's probably seeing this is a little easier if you kind of want to refer to the numbers. No one's gotten any of them yet? It just could be on a delay too. So rent. Rent payments 85, salary payment 60, rent 85, salary 70. Salary 70, rent 85. So it looks like Zuli and Joanna agree. Oh, so does Arjun. Good. No, Zuli's the one that disagrees, it looks like. So Zuli's a little off on salary payment. Matthew got rent 85, salary 70. All right, Zuli, so I'm guessing you might be off by 10 for your salaries. I think I know why. We'll see in a second. Marisol got the same. All right, so Joyce got salary 70. She got rent 85, good. All right, let me walk through it. All right, so we have a beginning prepaid rent, or any prepaid rent. All right, so with the beginning prepaid rent, let's kind of talk about that number first. Again, that's a payment that I made in 2019 for rent expense that I'm going to incur in 2020. So that's why I need to subtract it, because it's not an actual payment I made in the current year. And then the ending prepaid rent is the 15. Again, that's rent that I paid for now, but I won't expense it until later. Wait, can you go back for a second? Okay, let me go back for a second. I'm guessing this is what she wanted to see. Maybe she flipped the 10 and the 15. So yeah, the big thing there is because you're dealing with an asset rather than a payable, it is a little bit different. So you just have to walk through that. And so the salary expense, it sounds like everybody got that. Again, beginning salaries payable, those are payments I'm going to make in 2020 for salaries expense in 2019. And then ending salaries payable, I incurred the expense in 2020, but I haven't paid it yet. I'm not going to pay it till 2021, and so that's why it's a negative. And so rent payments are 85, and cash payments to employees are 70. So hopefully that makes sense. Oop, the broadcast just got super blurry. Anyone else? I hope not. I'm on a hardwire connection, so I don't think I'm having issues. Alright, so it might just be Dylan. Might be a bad Wi-Fi connection or something like that. Somebody's gaming there. Alright, that's what happens here all the time, by the way. Some kid will start gaming, all of a sudden my connection dies. Alright, now, so what we have here, again, just going back, we've taken our rent payment and our payments to employees. And now we're left with our additional items, which is the interest expense and also the income tax expense. But notice with these two items, there is no balance sheet item. So remember, we go from the income statement through the balance sheet to the cash flow. And so in this case, if there's no balance sheet item, that means there's no accrual. And in that case, if there's no accrual, that means that the expense is the payment. And so for the interest expense and the income tax expense for this example, the expense is the payment. So our cash payments for interest is 40, and our cash payments for taxes is 145. And so the cash provided by operating activities, when we add them all up, is 400. And the final thing we're going to show you is basically these are the two sections. On the left-hand side is the indirect method. On the right-hand side is the direct method. Both give you the same cash flow, but the way that the information is presented is very different. As an example, when you look at the left-hand side, you wouldn't really be able to ascertain that your cash receipts from customers was $1,450. You just wouldn't be able to really see that, or any particular item, in all honesty. And so this is why almost everyone uniformly agrees that the direct method provides more useful information. Yet the indirect method is the one that's required under FASB, and so under US GAAP. So I wish I had a good explanation for why they made that choice. It's one that I don't quite understand. I do think that that could change in the future. I'm not sure when, but I think that is something that for me, ought to change. I think that the information is better on the direct method, but that's just the way that it is. Thanks, Samantha. Hopefully everything was okay. We're pretty much wrapping up here anyway. Let me leave a few minutes here for any final questions. I think that was my last slide. So 100 and whatever slides later. Any questions? I'm going to give it a few minutes just in case. This is off topic. How many questions on the exam? Will there be class on Tuesday? So how many questions on the exam? So for the chapter 23, there's just a statement of cash flows. That's it. It's 50 points. And then as far as multiple choice questions, I don't remember. They're all from chapter 22. I mean, it's less than 10, I think. And then there's 2 problems. There's like 4 problems, I guess, for chapter 22, short kind of workout problems. Will there be class on Tuesday? I haven't decided yet. As far as, if there's an item, if there's topics that we think would be beneficial, I mean, for sure I can do a stream and we can talk about it. But I can't think of anything off the top of my head that I wanted to talk about. But again, if you want to email me or whatever and say, hey, I think it'd be good to go over this, or can we go over, whatever it might be, we can certainly do that. Yeah, only the long answer for cash flows. And then Natalia wants me to explain again the payment of interest and taxes. So let me go back to that real quick. So when we look at this interest expense and income tax expense, and so maybe more of the Canvas practice problems, yes. The only challenge is to build them into slides can be a bit of a challenge. I could maybe do it within Word and just broadcast that. We'll see. I'll toy around with it a little bit. So Arjun, chapter 22 is all multiple choice and short problems. Chapter 23 is one massive cash flow problem. Yes, to be 100% sure, Arjun, that is true. Getting back to Natalia's question, and then if there's anything else that comes in the chat, I'll come back to that. Again, whenever we're getting to the cash flow, it's all about going from the income statement through the balance sheet to the cash flow. In this case, if you look at the balance sheet, there is no item that relates to interest or income taxes. So there's no income tax payable, there's no interest payable, there's no prepaid interest, there's no prepaid taxes, there's nothing. And so what that means is if there's no balance sheet item, that means there's no accrual related to that item. If there's no accrual, that means that the expense is also the cash flow. And so the interest expense of 40 and the income tax expense of 145 are the cash flows. The cash payment for interest is 40, and the cash payment for taxes is 145. Hopefully that helps, Natalia. Did that answer your question? Yes, seems like they got it. As a general question, if you have cash used by investing activities, is that necessarily a bad thing? No, going back to that, it's actually preferred. Because when you talk about cash flows, if I can get, I know this is probably going to be a while. Bear with me for a second. All right. So when we have our 3 sections, our cash flows from investing activities, that's buying and selling non-current assets. And generally we want there to be payments for long-term assets, because those long-term assets are what you're going to use to grow the company. And so we want to see negative cash flows for our investing activities. Maybe not every year, but the majority of the time that's what we would want to see. We generally want to see positive cash flows from our operations, because those are those day-to-day core things that we do, and we want them to be able to generate cash flows. With the financing activities, honestly, I have not heard, and I can't think of any intuition that would suggest that we have an expectation for a positive or a negative cash flow from financing. I think it just depends on where you're at and what you're doing. Generally speaking, if it's, I would say if I were an investor looking at a statement of cash flows, the only thing that I would look into more is if there was a very large one. So let's say that I had cash flow provided by financing activities and it said 600. I'll be like, wow, so your operating activities is 400 and your investing activities is negative 140, and you have 600 from your financing activities. I would just want to know why. Like, what happened? What are you doing with that money? Or if I saw a really negative number, what are you doing with that money? It's not necessarily alarming. It's just a reason to investigate. And so again, with all these cash flows, positive on the operating side, negative on the investing side, and I'd say with financing, just nothing too large is generally what we would expect. Any other questions? For the test, we'll be required to use the indirect method, yes. And then the direct method, you'll have to reproduce the operating section using the direct method. So in other words, what you see on the slide right now, this is what you would have to see. You would absolutely have to see both of these items. So you do an entire statement of cash flows using the indirect method, and then you would reproduce the operating section using the direct method. And so we'd want to see both on the test. Oh, it's Carolina. Sorry. I just name got blocked there. I didn't see it. Any other questions? Have I decided on time for the exam? It will be at least 105 minutes. I haven't decided whether I need to add more time. Honestly, the time crunch has never been an issue when the students are taking it in class. I am trying to judge how difficult the spreadsheet is to work with. Honestly, I've practiced a couple times with it, and it's not that hard for me. So honestly, I think it's actually not that bad. Yeah, the cash flow problem seems like a brute. So generally speaking, I think it will take you about 45 minutes to do the cash flow problem. That's on average, so 45 minutes or so, maybe up to an hour. But that still leaves you, if it takes you 45 minutes, still leaves you an hour to do the Chapter 22 stuff, which is more than enough time for that. I know everyone wants more time. Everyone wants more time. It's one of those things that there's always that debate as a professor of, especially with an open note test. If I have too much time, then I'm not really testing your knowledge. I'm testing your ability to look stuff up. And so that's the balancing act that I'm dealing with, is having, and even I know in class that 105 minutes would be almost too much time. I would have students just, sitting there thinking without, even getting anywhere. But yes, this transition to online is a tension that I'm dealing with. We'll open at 10. I think it's actually, yes, it goes from 10 to 105 minutes after that. I don't remember the exact time. It should, when you click on it, it should tell you, I think, when it's first available. Any other questions? All right, everybody. Hope you all have a good one. I'm glad, Ryan, that they've been helpful. It's been well worth it. Like that, I wasn't sure if it was going to be helpful. I'm glad that it is, and they've been fairly well attended. I think we had up to 20 people watching, so that's not bad. You're welcome, Arjun. You're welcome, Natalia. You're welcome, Zuli. Thanks, Joyce. Thanks, Marsal. Thanks, Carolina. All right, everybody. Have a great weekend. and I'm sure we'll touch base next week. Feel free to reach out if you have any questions in the meantime. Have a good one, everybody.